Good morning, everyone. This is Marshall Giller bringing you the morning comment for January 29th. Well, the Fed and the Reserve Bank of New Zealand were both largely as we expected. The FOMC statement was pretty much unchanged, while the RBNZ changed from a tightening bias to strictly neutral. As a result, the dollar rose against almost all the currencies we follow, while the Kiwi was the biggest loser. The FOMC was more confident about the labor market and the economic expansion. They thought inflation might remain below target for longer than they had expected previously, but at the end of the day, they still expected to return to their 2% target eventually. A steadily improving labor market and inflation headed back to their target means that they're still on track to begin normalizing rates later this year, in contrast to most other central banks. Now, the market view of the statement was mixed. Fed funds rate expectations crashed, but the dollar rose and stock prices fell because they didn't retreat from their tightening bias. I remain a total dollar bull. The FOMC is clearly determined to begin the process of normalizing rates, which sets it apart from virtually all other central banks, and this should keep the dollar underpinned. The RBNZ, on the other hand, followed the global trend towards loosening. Governor Wheeler said that we expect to keep the OCR on hold for some time, and out of that, future interest rate adjustments could be either up or down. This is a big change from their previous tightening bias. The statement was focused on the downside risks to growth. Wheeler also continued to complain about the overvaluation of the New Zealand dollar. I think Kiwi will continue to sink against the US dollar. Nonetheless, I still expect it to do better than the Australian dollar. We'll have to see whether the Reserve Bank of Australia also changes its bias at next week's meeting. In fact, the market's now likely to expect most central banks that don't already have a loosening bias to shift. I suggest you also keep watching Greece. The Greek situation hasn't settled down. On the contrary, it seems to be getting more and more agitated. Greek stocks, which haven't been doing very well recently, were down another 9% or so yesterday, while three-year bond yields moved up 275 basis points. February 5th is the next pressure point, when the emergency liquidity assistance to the country's banking system is up for renewal at the same time as the parliament reconvenes. The Greek situation still has the potential to roil the euro more. As for today's highlights, the main release will be the German preliminary CPI for January. The consensus is for a decline to deflation, which could add further downward pressure on the Eurozone's estimated CPI to be released on Friday, and could therefore prove euro negative. In the U.S., we get the initial jobless claims for the week ended January 24th. Pending home sales for December are forecast to decelerate. This is in line with a modest increase in existing home sales in December. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.